Hello and welcome to the Gables of Cornerstone, located in Lynchburg, Virginia. My name is Kevin Dean with Rockbridge Investment Group, and I am joined with one of my partners on this deal, Rebecca Taylor of Tailored Investments. Hello, Rebecca.
Hey.
We're very excited to present this opportunity to you today, and just thankful for you even taking the time to look at it. This is going to be Rockbridge Investment Group's third multifamily acquisition in Lynchburg, Virginia. And there are a lot of aspects of this deal that we love, which we're excited to get into. So before we do, a quick disclaimer. This is a 506B offering, meaning it's available to both accredited and non-accredited investors. If you have any questions about that, you can reach out to Rebecca or myself. And then, I would just encourage anybody watching this to just pause this slide, read through this disclaimer, which outlines sort of how we compiled the data here. And then the last thing is, if you have this webinar recording or the offering memorandum, if you do want to share it with anybody, please just reach out either to Rebecca or myself, just so we can make sure we keep tabs on who has this presentation, just given the nature of the offer. Mm-hmm. So with that being said, a little bit about the team. Rebecca and I are both on the call. Rockbridge Investment Group, we're the lead sponsor on this deal. We've owned and operated over 2,800 units, primarily in West Virginia, North Carolina, South Carolina, and Kentucky. We're based in Virginia, and we really focus on value add investment opportunities. So as you can see, we've got a really strong team here. Not only do we have people in Virginia, but we actually have a partner who's located in Lynchburg, Virginia itself, which is amazing, just to have the boots on the ground, to really kind of keep tabs on what's going on with the property and make sure everything's functioning properly. So really excited about the team we have on this investment. In addition to the core team, we also have some vendors that we have worked with numerous times, from legal to lending to insurance. The one that I would point out on this slide is Carlisle Residential Properties. They are a full-service property management company based in Greensboro, North Carolina, who already managed 3 assets for the Rockbridge team, and they're taking on another few in Lynchburg for us, including Gables of Cornerstone. They are a top-notch team that's been involved in over 10,000 multifamily units in the region. So we're excited to be partnering with them and having them kind of drive the ship on this investment. So with that said, I'm going to pass it to you, Rebecca, to just get into some of the overall details of the deal.
Absolutely. Thank you, Kevin. It is good to be here. My husband and I have been investing in Lynchburg since 2012, and we actually live in Lynchburg. So this is very exciting to be working on this deal here locally for us. I've worked on properties all over the country the last couple of years with the syndication space. And so this is really neat to be able to do it locally and be able to see the property on a regular basis. So I'm very excited to be working with Kevin and the team. So just a quick look at the executive summary. This is a 100-unit property. It's Cornerstone, as he mentioned. It's in a really great area of town. We were just there a couple of days ago. For this deal, it's a 6% preferred return, which means basically investors are given the first 6% of distributable cash flow from the property annually. And then after that, there's a 70-30 split between the limited partners at 70%, the general partners at 30%. This is a 5 to 7 year hold time, and we're projecting an equity multiplier of 2 to 2.5 times on your money. So just a quick example of that, I always tell people to make it easy. Let's say you invested 100,000. At the end of that hold, you should get back your initial 100 plus 100 to 150,000 in profit on the back end. So there will be some cash flow throughout, between 7 and 9%. And I think that's really strong. In this market, we're getting an awesome property that's already very well stabilized and established and already cash flowing out of the gates. And so it's a great place to put your money, where you're feeling comfortable again, getting some cash flow, but also seeing large profit on the back end, which we'll hit on a little bit. But we are looking to raise $5.75 million in equity for the property. There is $15.5 million total for the capital structure. We're getting $9.8 million in debt. We'll hit on the debt in a little bit, but the overall IRR we're projecting is between 15 and 17% at that LP level. So that's a quick look at some of the numbers. We'll dive into that a little bit more in a minute. In terms of the equity structure here, you can see it's broken down a little bit more. I think I've looked at a lot of deals over the years. I've been a part of a number of deals over the years, and I think that this is a very fair, favorable split for the LPs and the GPs. Again, you're seeing 70% at the LP level and 30% at the GP level. So again, you're going to get the first 6% at the preferred return level, and then after that, at the cash flow is going to be 70-30, and then the equity ownership on the back end is the 70-30 upside participation. So it's very simple. There's not, you might see other deals out there that get very complicated. And one thing I like about this is how simple it is for all levels and all groups involved. In terms of the return summary, this is going to give you a little bit deeper dive into your investment and what the projections are each year. So you can see in that top level, the return on capital each year, the cash flow should increase over time. And that cash on cash is starting at 6.3%, and then it should get up to around 8.4% in year 6, 8.8 in year 7. These are all projections. Please keep that in mind. This is not guaranteed. No investment is. There's always risk associated with it. But you'll see that at the very back end of your investment is when you'd see that return of your capital if it's, say, 100,000. And then one thing I'll note, at the very bottom, the total return, you can see you've got your investment of 100,000 each year cash flow, and then the back end profit at the sale of the asset. So if you add 197,000 plus each of the numbers before that in terms of like your cash flow, you'll be up around, say, 250, 260. I don't have the exact number, but again, that's a projection. That's showing you what the equity multiplier would be on your money. If you put in 100,000, you'll get that back plus, say, 100, 150,000 in that cash flow or that profit on the back end. As far as the business plan, this property is being sold to us by the original builder. It was an off-market deal. They live locally in Lynchburg. They built the property in 2008. They've owned it the last nearly 16 years. I've lived in Lynchburg since 2004. I came here for college, and I'm one of the ones that stuck around. I love Lynchburg. It's a great town to raise a family. There's so many wonderful characteristics about the city. And so this property is just in a phenomenal area. There's a lot of other retail stores, restaurants, a workout facility. We'll hit on the amenities in a minute, but this builder has done a phenomenal job taking care of the asset. When Kevin and Carlisle walked through, they said this was one of the very best assets they've seen, and they've walked thousands and thousands of units. And so that's encouraging. There's not a lot of CapEx required. We do have money that we're setting aside for CapEx, but it's not necessarily required right into purchasing the property. It's already at just about 100% occupancy. So there's an opportunity to improve those units over time, but we're already buying a really solid asset that's in great condition. And so we're getting it also at a discount at around $132 per door. We'll hit on in just a minute what else is going, what the market rates are for other units in the area, and it's far above that. So it's great that right out of the gates we're getting a low price and we're getting built-in equity there. And so we'll talk more about the underwriting here in a little bit, but with it being off market, we're getting some seller financing at below interest rates at 5% for the first 3 years on the loan term, and then 6% for the 4th and 5th year, and it's interest only. So that's exciting. And then on the agency debt, we have fixed rate, which I think is so important in the current economic environment. We've seen a lot of deals go south because of some of the adjustable rate mortgages that sponsors have taken out. And it's been a really hard lesson for people out there that we're looking to get really low debt, low rates. And now those are really increasing, and it's making it hard to make money on your property. So I love the fact that this is fixed debt. I think that provides a lot of protection for us and for you as an LP. A little bit more on the business plan. We are budgeting $4,000 per unit for the interior renovations. And then we're budgeting about $2,500 for exterior per unit. Again, 15-year ownership. It's not a brand new property. It's a little bit of a vintage, but with it being in such good shape, I think that's in our favor. It's a growing university town. There's a lot of awesome colleges. I love Liberty, and there's many others there that are phenomenal as well. outstanding cash flow opportunity, again, with a low risk business plan. The fact that it's already cash flowing, it's in a really great location in town. There's just a lot of upside there. The economy is very diversified. We'll hit on that again here in a minute. It's growing. And these floor plans are also really large. They're over 1,000 square feet on average. We've got both 2 and 3 bedroom units. And so there's some options there for tenants and what they're looking for in terms of size and bedrooms, and an opportunity to raise the rents a little bit. They don't really need to be raised a whole lot because we're already hitting what we had underwritten here at the beginning, which is exciting. We don't even have to raise rents much to hit those projections right out of the gates.
Yeah, just to kind of dive deeper into what Rebecca's already hit on in terms of the purchase price here, you can see in the same complex, there are the exact same unit types that have sold for as high as, $237,000 per unit. And we're buying it at $100,000 less per unit. So, at a high level, the way we're thinking about this deal is it's a very low risk business plan where you're basically buying the asset at a really great price. And we'll dive into the rents on the next slide, I believe. But as Rebecca mentioned, we're already basically getting the rents that we underwrote to, and we haven't even acquired the asset yet, even though we've budgeted significant capex post closing. So, like, just going in knowing that you have kind of, quote unquote built-in equity based on the purchase price alone, I think is huge. And I think really what that comes back to is we just spent a ton of time building the relationship with the seller, personally, and he's a great guy who has just done an amazing job with these properties. And I think for him, it's really important that the group coming in buying it is going to take great care of the properties and make sure, when he drives by it in 5 to 10 years, he's not upset that he sold it to us. And I think that the purchase price kind of reflects that a bit, in that he probably could have gone somewhere else and sold it for more, but it's more meaningful than simply a price to him, which of course to us and our investors is a huge benefit. And of course we want to make sure we live up to that standard.
And he also has some other assets locally that we are hoping to potentially purchase in the future. So that's exciting. There's opportunity for growth outside of even this. And obviously Kevin and the team own 2 other assets in Lynchburg, so they know this market, which is given me a lot of confidence in partnering with them on this.
Yep, could not agree more. On this slide, really what we're showing is, if we use CoStar as a data provider to kind of check our underwriting and making sure that the assumptions we're making are accurate, or at least reasonable, I should say. They are projections, so you don't really know. But really on this slide, we just wanted to show that CoStar is projecting average rental growth over the next few years of 4%. We're underwriting 3%. That may not seem like a huge difference, but you can see when you take that 4% growth over a 3-year period, the gap in what rents could be are, substantial. So this again just kind of shows, we're really trying to be conservative with our underwriting, make sure that we're under promising and over delivering as much as possible. And, we really believe, and we'll kind of just go right to it right now, that we'll be able to outperform our rental projections. That's actually a following slide where we'll get into the rent comps a little bit more. But Rebecca, I will let you hit on this slide specifically. I know you had some thoughts on this.
Yeah, this is just giving us a comparison of renting at Cornerstone Apartments versus if you were buying. And the prices that we're seeing for condos in this area are around 223,000 or more. I have my real estate license, and so I do see some transactions, and it has been really hard to buy lately because of where interest rates are at. Prices are still high on properties. So this just gives you a look at, if you put 10% down plus your closing cost, you've got a mortgage of around 200,000, and then your estimated monthly payments, that includes your principal interest, your taxes, your home insurance, or HOAs, ongoing maintenance. Again, you have some reduced location flexibility, but you're spending a pretty significant amount every month to buy the same unit versus renting it. It's around $1,400. So it's more affordable to rent. And we're seeing so much of this generation that likes that flexibility. They don't necessarily want to buy. They don't want to settle down. And if they do want to settle down, they might be looking for a house, and they're just not able to make the numbers work right now. So I like the fact that we're able to provide something that's affordable, but it's still a great place for people to live. And, in this market, it's just kind of a no-brainer if you're trying to decide between the two and you just don't know if you're going to be around long-term. This is a cheaper option.
Yep, it's simple. Like when you just step back and think about it, like the decisions that renters are making, do I buy where I have to put down this much money and then it's going to be this cost, or I can just go rent. I have the flexibility. So it's
Mhm.
nice when you just think about it in a simple manner. It actually makes sense.
Yeah. Mhm.
So in terms of CapEx, Rebecca already mentioned this a little bit, but we are budgeting $400,000 for interior renovations, and then we're also budgeting $290,000 for our exterior budget.
Mhm.
The reality is, we really don't need to spend any of this money on day one. We like to be conservative and have cash on hand to account for any potential issues that we could face. Which there's always going to be something that pops up that we did not account for. So we're already the current owner is already getting $1,391 on the two bedrooms. We underwrote $1,400. He's getting over $1,600. His market rent for the three bedrooms is already over $1,600. We're underwriting $1,600. So typically with a value add deal, you need to put in say $5,000, $10,000, $12,000 per unit, depending on the deal, to raise market rents. In this case, the deal works without us actually raising market rents. They're already where we need to be. So just from like a risk, like an execution standpoint on executing the business plan, we feel really good about the fact that we can keep these monies in reserves, and maybe we come back in year 3 or 4 and do a heavier renovation on some of the units. But this is really more just kind of like a reserve fund that will help everybody sleep better at night.
Mhm. And I know you usually put these in like a high yield savings account
Yes.
where accruing some interest. Right now, interest rates are high, so we can make money on that money that's just sitting there, which I think is a smart use of everyone's money.
Yep. Yeah. Our CFO Connor Stockley is just dialed in on always making sure we're getting the best rate possible. And, we have
Mhm.
the appropriate amount of funds in the various accounts. So that'll certainly happen.
Yeah.
Okay. So in terms of rent comp, so uh, people who live in Lynchburg will probably recognize some of these properties, but these are all in pretty close proximity to Cornerstone. And really what we wanted to show here is if you look at the unit sizes here compared to the average in the market, they're bigger. And on a dollar per square foot basis, we're projecting charging less than average. So that, of course, our goal is going to be to push rents as much as possible while maintaining occupancy. But the business plan is contingent on just hitting these levels here, which we've already kind of expanded on. They're already getting 1391 on the twos. So if we can increase rents $9, which I think is very doable, especially as we hit peak leasing season here in the next few months, then we hit our 2 bedroom projections. For the 3 bedrooms, their market rents are already about $25 higher than what we're projecting. So as long as we can just sustain what they're already doing, we're going to be hitting our projections, which is it's nice because we've done a lot of business plans that are contingent on a $250 rent bump or a $300 rent bump, and that's great and that can work. But in this market right now, we're finding that we're able to make deals work without doing these massive rent increases, and it's rare. I'm sure Rebecca, you can attest to how many deals have you looked at that you need to hit that rent projection, right?
Mhm. Yeah.
So it's nice just again going back to sort of the lower risk business plan. We don't think this is going to last forever, but it's nice that this is working right now.
Yeah.
Okay, and then so here really what we wanted to show is a few things. One, you can see that this Gables of Cornerstone property is located within a larger master development. So again, location is prime. You've got access to the amenities, the pool, playgrounds, grilling stations, and then kind of some of the intangibles like Mission House Coffee, where which is walking distance from this property. You've got Iron and Ale, you've got Mellow Mushroom, you've got the gym there. So, this is not just an apartment complex with units, but it's also got really good walkability. It's right off the bus route for Liberty University. And it's an ideal location.
Mhm.
And then I guess the other thing I would hit on in this slide is the unit sizes are really large. So, it's nice when you have all 2 and 3 bedrooms. You do want to have sort of diversity of your unit type. But if you have to choose, the more, 2 and 3 bedrooms you can get, the more rent you can charge, the better that is on a per door basis. So it's nice just that we have, 1,062 square foot 2 beds and over 1,200 square foot for the 3 bedrooms, just really attractive floor plans.
Mhm. As far as the amenities, there's a lot of great amenities around here. You can see this list. One of the best that we like is just the in-unit laundry, having your own washer and dryer, and they're not having to bring it in themselves. We provide that. There's also a pool and a cabana. There's, again, so much walkability. There's trails, retail restaurants. It's just a really great area. Very busy and happening, and I always enjoy going over there. It's amazing how much it's grown in that part of town compared to when it wasn't in existence back in 2008 when I graduated from college. So it's been really neat to see, and just a great place again for people to live and enjoy all these amenities.
Yeah, could not agree more.
Photos, yeah.
So in terms of just some of the stats, whenever we're going into a market, we take a top-down approach. So the most important aspect of any deal outside of arguably the team is the market. So one of the reasons why we love Lynchburg is, Lynchburg isn't going to be your Richmond, Virginia, or your Charlotte, where it's going to be the fastest growing market in the country or in the state. But Lynchburg is pretty stable and steady. So there's a good amount of employers that really kind of keep the market stable. Everybody knows Liberty University, of course, and you've got Centra, the hospital system there. But just from like an industry standpoint, we like the fact that no single industry makes up more than 15% of the employment base. So healthcare is leading the way, very stable industry, making up about 14% of the jobs in the market. And then you've got educational services, again, a very stable employment base, especially in Liberty University being such a unique school. It's not like your typical, state school. Then you've got manufacturing, retail, trade, and construction. And then just from like an employment growth standpoint and a unemployment rate, it's standard. There's nothing jumping off the page, but the market is consistently growing. There's not a ton of new supply coming on. So, as you have people coming to the market, whether they're graduating from Liberty and staying, or they're moving from DC for a lower cost of living, you've got population growth and employment growth, which is outstripping the pace of new apartment complexes in town. And on site, within a 1 mile radius, the median household income is over $50,000. So, if you're making over $50,000 and your rent is, $1,400, that's pretty affordable in terms of like your actual percentage of your income. So these are just some stats that make us feel more comfortable about, this specific submarket and market of Lynchburg.
Mm-hmm.
Some of the major employers we already kind of hit on a little bit, but of course you've got Liberty University, you've got Centra Hospital, you've got BWX Technologies and Framatome, which are really on the front edge of some nuclear technology, receiving a lot of business from sort of the federal side. And then of course you've got your staples like Lynchburg City Schools, and then other just retail and other smaller universities in the market. But as you can see, Cornerstone is not located too far from Liberty University and a lot of these other employers. It's kind of still in the city of Lynchburg, but on the path towards Forest, which is where a lot of the growth is going in Lynchburg. Rebecca, I don't know if you want to hit on that at all, just given you're local to Lynchburg, just in terms of the location and the employers around.
Yeah, I mean, it's just right in the center of so much of Lynchburg. I mean, you just have easy access to like you said, to Liberty, to the airport. Downtown's not terrible drive, 10, 15 minutes. I mean, you could get over to Windhurst, which is a great little community. Forest. I mean, yeah, it's ideal, I feel like, for just about all of your needs. You don't have to go very far to get just about anything from that location.
And I think one of the things that also doesn't get accounted for is just how many people actually are working from home in Lynchburg. So like my sister-in-law, she works for a company that's based in DC. She goes into the office twice a year and she lives in Forest. Another good friend from high school went to Liberty, graduated. He works for a company based out of Tyson's up in Northern Virginia. He lives in Lynchburg. So there's a lot of jobs that aren't necessarily accounted for on this slide that are paying, good salaries for people who are looking to live in Lynchburg, work from home, and benefit from that cost of living that you're not going to get in Northern Virginia or DC.
I used to live in Northern Virginia. Kevin and I talked about this, and I liked the amenities, but man, cost of living was so high. Traffic was terrible. It wasn't as pretty. No offense, Kevin, but
well, where I live, it's beautiful. If I could take my webcam and show you, I'm like right below a mountain. I don't know if it's Lynchburg quality, but I hear you. You know,
It's a pretty
Maine,
area.
Northern Virginia, you're 100% right. Lynchburg is much more beautiful, so I'm not going to deny that. So here's just some recent market developments that have happened over the last few years. Again, BWX Technologies has made substantial investment into the Lynchburg market, creating over 300 high-paying jobs over the last few years. Liberty University just seems to constantly be expanding, which again, that's an employment base. It's bringing more students to the university. They've got a huge endowment, and they're just investing into growing the university, adding programs. Centra Health has also announced recently a few new locations that they're going to be propping up in the next couple of years in the market. And then one of the things that I love about Lynchburg, and I know Rebecca, you and I talked about this a little bit, is just how entrepreneurial it is. And it just seems like there's a lot of people who are willing to go out and start a restaurant or a coffee shop or a gym or, whatever it may be. And I think that that actually adds some cushion to the market where, when you've got one employer who's making up all of the industry, if that employer goes out of business, that's a big risk. The fact that people are entrepreneurial in this market and starting their own businesses, I think, again, adds to sort of the stability and like constant growth of the market.
Yeah, I agree.
And then, again, just the fact that Liberty or Lynchburg is a university town. Liberty University, of course, is the staple, but there's a number of other universities offering programs, which again, I think just adds to the continuous growth. People are always new people are coming into the university system. Some people are going home, some people are graduating and staying local. So I think, the fact that there are this many universities, it makes it attractive for employers to set up shop in this area, even if it's not your giant company. If it's mid-sized companies who are looking for good talent with good degrees from the local universities, they've got a nice crop of people graduating every single year to choose from. So we really see that as a benefit.
Absolutely. And on top of, just the universities and the employment diversification, I mean, there's also some really great areas around Lynchburg. I mean, downtown is transformed over the last 10 years. It's so different from when I first moved here. It's such a great area to explore, tons of restaurants and shops and breweries and art and shows, the Academy. I mean, it's just a booming area. We also have a lot of parks around town. We have Riverside Park, Peaksview Park. We have tons of other ones. We have Blackwater Creek, lots of trail systems. We also have multiple avenues for sports and entertainment. We've got Smith Mountain Lake less than an hour away, and that's just a beautiful place to enjoy vacationing and just be out on the water. We've got like the Appalachian Trail. There's just a lot of so much around the area outside of just your university, your education, and your employment opportunities. So I think that draws people in as well. Again, I lived outside of Lynchburg for about a year and then came back. My husband and I came back because we just missed it so much. We love it here, and we've been able to. I mean, from a rental standpoint, we've had rentals here for many years and never had any issues renting them out, just because I think people enjoy living here in this area, and they're drawn in by so many different options and amenities, and it's a beautiful place.
So just to kind of expand further on the location, we're not going to go over every single retailer that's here, but I think that this slide just really highlights what is around the property. And, if you're a resident and you're looking for somewhere convenient to live, whether you're a Liberty student or you're a graduate or you're just, living in Lynchburg, there's so much to choose from like a retail standpoint and also from an employment standpoint. And that's kind of what this slide shows, is just that central location that is inherent with the Cornerstone location. Okay, so we kind of already hit on a lot of this, but I guess one of the things that I think is just worth mentioning on this slide is the debt service coverage ratio of 2.2. And what that means is if you take all the revenue on the property, you subtract all the expenses, and then you divide that by the debt, we have a 2.2 multiple over that debt payment, meaning, there is a lot of cushion between our expense and our debt load every single year and, how much revenue we're making. So that kind of just makes us feel good from a risk standpoint that, if occupancy dips a little bit, if we have, some insurance claim pop up, the property is still probably going to be in a cash flow position regardless. It's very hard to get below break even on this asset, and that's really just given the purchase price we're buying it at, and then the fixed rate debt that we're replacing on the asset.
Kevin, also, do you mind hitting on, I mean, one thing that I think Kevin has a lot of strength in is the financial side. I mean, do you mind hitting on your past experience before Rockbridge and all that you did on that end with debt and understanding these numbers very well?
Definitely, yeah. So I actually used to work at Fannie Mae on the multifamily desk. So my old boss and coworkers are the ones who are giving us the debt terms on this specific deal because we'll be going to Fannie Mae. So yeah, when I was at Fannie Mae, we would price about $200 billion worth of multifamily loans every single year. So that's over on average $4 billion a week of deals. So we saw everything from a $2 billion portfolio to a $3 million, small multifamily property in Roanoke, Virginia, for example. And it was all over the country. So I think what it really gave me was just a good perspective on what the best of the best operators did. And then the people who got in trouble, what did they do wrong and what went wrong? So, our nature as a company is always to just be as conservative as possible. Last year we underwrote over, meaning we evaluated and came up with a price and a return and business plan on over 300 deals. So we're passing on hundreds of deals before we choose one, and I think that just goes back to wanting to making sure that from like a risk standpoint it makes sense. We're going to be able to sleep at night. We're going to be able to under promise and over deliver to our investors. And then, we have friends and family who invest in all these deals. My dad, invests in it with his IRA, for example. So just, all of that being said, we want to just make sure we're doing our due diligence on every single line item of a P&L and every detail of the business plan.
Absolutely. One other thing, do you want to hit on the reversion cap rate a little bit? That might be
Sure.
confusing for some people watching this.
Yeah, so the way that these multifamily properties are valued is based typically on what sort of yield can I get? What kind of return can I get if I buy this today? So the simple way to do that is what is my net operating income, the profit at the end of the year divided by the purchase price. That is your cap rate. So, when we're looking at returns, we're projecting out cash flows in the future, and then we're saying, hey, what do we think we can sell this at? And, based on our best guess and using data from other properties, we believe we'll be able to sell this property at least a 5.5 cap rate. And the way that the way we came up with that number is we looked at recent sales in the market over the last few years and what they sold for on a cap rate basis, and then also on a per unit basis. So, there's been deals that have sold for over $250,000 per unit within a few miles of this property that had rents that were actually lower than what the rents are right now at Cornerstone. So somebody paid double what we're paying for this property, even though the rents were lower. So when we look at the exit cap rate here at 5.5%, and it works out to around $210,000 a unit on the sale. After we've done the value add and increased rents and increased profitability, we feel like that's being relatively conservative on the back end.
Okay. That's good. Thank you. Sorry if you're hearing my phone is connected to my computer and I don't know how to disconnect it.
No,
So I don't know if you can hear that ring.
It's actually not popping up, so you're good.
Okay.
So on this slide, this is really just our underwriting. The one thing I would highlight here is if you look at what the current owner did from a profitability standpoint last year, they made over $1 million on this property. We're saying that, hey, we want to be conservative. We're expecting our profitability is going to go down by over $140,000 in year one. So our goal is not to make less money. The goal here is really just to say, hey, we want to make sure, again, we can under promise and over deliver. And that's kind of reflected in this underwriting here. And if anybody wants to see the underwriting, we're happy to share that with you as well. Excuse me. So on this slide, just want to dive into the financing a little bit. So we'll actually have two loans on this deal. One is coming from Fannie Mae, as we mentioned, and then the seller is actually also giving us a $1.5 million seller financing note. at 5% for the first 3 years, and then 6% for the next 2 years, fixed interest, and it'll be interest only. So this is, when you mix in the fact that the seller financing is what we would consider to be below market at a 5% rate, that's what's really enabling us even further to have that cash flow throughout the hold period. Most people right now, if they're buying deals, they're only going to get that first loan from Fannie Mae at the, say, 5.8% rate. Because of our relationship with the seller, he knew in order for us to really make this deal work and make the returns attractive, we needed that seller financing piece as well. So that, again, just kind of further it really helps us get to a good return profile for our investors here.
Mhm.
And then one of the things that we do on every single deal is what's called a cost segregation. So simply put, all this is doing is it's helping us from a tax standpoint throughout the life of the deal. So part of the Jobs Act back in 2017 allowed for you to take bonus depreciation year one, which basically means we look at a property and anything that is, has a depreciable life of less than 15 years, you're allowed to actually segregate that and take that as a write-off in year one. So what that looks like is, say you invest $100,000 and you get a $6,000 in cash flow in year one. Your actual tax return from this investment at the end of the year may show a $35,000 or a $40,000 loss. Doesn't mean that you actually lost money, but it is a way to reduce your taxable income within these investments. And really, this is just an incentive from the government to fix up properties for real estate investors. So, one of the things that a lot of our investors do is if they invest in one of our deals that may be selling this year, if they invest in a deal 5 years ago that's selling this year, they may say, hey, I want to make sure I'm investing in another deal so that I can get that cost segregation to offset some of those gains. So again, this is just a benefit from the government that we take advantage of with our CPA.
Mm-hmm. And always consult your CPA as well, because there's a lot that goes into these things, and so make sure that you're using somebody that knows what they're doing. We definitely don't claim to, I don't claim to be. Actually, Kevin knows a lot more about the CPA side of things than I do.
Well, I'm with you. Yeah, I'm not a CPA, so definitely disclaimer on that front. But for about 90% of our investors, it kind of looks the same. But completely agree, Rebecca.
Mm-hmm.
So just to kind of further hit on the point of just being conservative here, when we look at deals, we want to look at, best case scenario, worst case scenario, likely scenario. And one of the ways we do that is just through a few different scenarios. So really on this slide, what we're showing is, hey, what happens if there's no rent increases at all? What does that look like from a risk standpoint? What we show here is we're still hitting over a 1.6 debt service coverage ratio with the amortizing debt in year three. So again, plenty of cushion, even if we can't increase rents. Then we say, all right, well, what happens if rents go down by 5%? You still have 50% of coverage over your debt. So again, from a risk standpoint, you're looking pretty good. And then probably the most important number from like a risk standpoint that we consider is, what is my break even occupancy, right? So this property right now is completely full and occupied. And really what our financial analysis shows us is, as long as we can maintain at least 69% occupancy, we can pay all of our expenses and our debt and just break even. So the likelihood of 31 residents all moving out at the exact same time is extremely low. So we feel pretty good about that. Last thing I would hit on is, we already mentioned the cap rate a little bit. This just kind of shows, all right, if the market is a little bit hotter or a little bit cooler, what does that do for returns? And kind of what we're showing here is, let's say cap rates go down to 5%, which means the market is hotter. You could see your IRR go up closer to 18%. If on the other side, pricing comes down and maybe we're not in as strong of a market, we project that we'll still be able to provide around a 14%, IRR, which is effectively like an annual return. So it just kind of goes to show the exit price is important, but a lot of the cash flow, a lot of the return on this deal is coming from cash flow. So, the pricing isn't going to make that big of an impact on the actual return throughout the life of the deal. And then is, go ahead, Rebecca. Sorry, I think you're going to
Yeah.
take the slide.
Oh, no problem. This just gives you a quick look at the fee type or the fee disclosures, just so that you're aware. We already talked about the 70-30 split, 70% to you, 30% to the GP. It is quarterly in terms of the cash flow. So that it's not monthly, it's quarterly. We also have a management fee for overseeing the asset. It's 2%, and that's taken out monthly. That is based on the revenue of the property. So keep that in mind too. We need to be executing on the business plan to be able to take advantage of that management fee, because if the property is not performing, then we're not going to be getting revenue. So again, I feel like we're being very conservative, and we've got an awesome team that's going to keep running this property very well, which I feel very confident in. Also, there's an acquisition fee. It's 3%. That's the fee for finding the deal, structuring the plan, securing the financing, and risking the earnest money. So there's a lot that goes in on the front end when we're acquiring these assets, and that's why there is a fee associated with that. And then lastly, there is no disposition fee, which I think is fantastic for investors. I see a lot of other companies out there that do a dispo fee. So just keep that in mind too, that we really do we put our investors first. That's really important to us. And so keep it simple with optimal alignment for our limited partners. In terms of the timeline, we have a portal. It's an InvestNext portal that you're going to be able to go into. I'll provide you with a link, or Kevin can, and that's where you're going to place your soft commitment. You'll need to open an account with InvestNext first through us. And so you'll just have to put in some basic information, open that account. And then please do review due diligence documents. There are a lot of documents, including the private placement memorandum and offering summary. And so please make sure you review all that. If you have an attorney you want to review that, definitely do so. It's important that you know exactly what you're getting into. And if you have questions along the way, please don't hesitate to reach out on that. Once you have reviewed all those documents, then you're going to want to sign those and then wire the funds for the investment. And so do keep in mind too that with an investment like this, as I've told many of you, your money is locked up for that time frame. It is a liquid for this 5 to 7 year hold period. And so do keep that in mind. For the funding, we're going to open that up March 25th. And so that will close on April 30th. And then the investment is set to close on May 13th, right, Kevin?
That's right.
And push that back a little bit if needed, but May 13th is when we're planning to close. And again, if you have questions, don't hesitate to reach out. We really appreciate your time today. We're excited about this opportunity and really excited to bring on some of you into this deal. So if there's anything that we can do to help you, please don't hesitate to reach out.
Thanks, everybody.
Yeah, thank you.